Fibonacci time zones are vertical lines based on the Fibonacci sequence. These lines extend along the x-axis, or date axis, as a mechanism to forecast reversals based on elapsed time. A major low or high is often chosen as the starting point. Distances start relatively small and grow as the Fibonacci sequence extends. Chartists can extend the Fibonacci time zones into the future to anticipate potential reversal points. The slow start in the Fibonacci sequence creates relatively tight clustering at the beginning of the Fibonacci time zones. Sometimes, it is necessary to ignore the first 5 or so time zones after that point, the zones expand quite quickly as the sequence unfolds. According to the theory, potential reversal points can be found by looking ahead 21, 34, 55, 89 and 144 days, all of which are Fibonacci numbers. 21 days marks the 8th Fibonacci time zone. Some subsequent zones are listed as follows. 8th zone equals 21 days or periods. 9th zone equals 34 days or periods. 10th zone equals 55 days or periods. 11th zone equals 89 days or periods. 12th zone equals 144 days or periods. 13th zone equals 233 days or periods. Remember, you can find future time zones by adding the previous 2 time zones. For example, 89 plus 144 equals 233. Chart on the screen shows the NASDAQ 100 ETF, or QQQQ, with the Fibonacci time zones extending from the March 2009 low, which was an important low. The first 7 time zones are difficult to use because of the tight clustering. The sequence gets some breathing room starting with the 8th time zone, which is 21 days. The 9th time zone, which is 34 days, coincided nicely with the July low. The 10th time zone, which is 55 days, occurred in the middle of an uptrend and was not significant. The 11th time zone occurred near the February low. Chart on the screen shows QQQQ with time added to see the next Fibonacci time zone. The next Fibonacci time zone comes at the 155-day mark at the beginning of September 2010. QQQQ has been trending lower since late April, and this zone could mark an important low. The chart on the screen shows the Euro ETF, FXE, with the Fibonacci time zones extending from the April 2008 high, which marked a major high. The 8th Fibonacci time zone, which is 21 days, marked a top in July. The 34-day line did not mark anything significant, and the 55-day line marked a significant low. The March 2009 high formed just after the 89-day line, and the November high was a month after the 144-day line. As with most forecasting and cycle tools, a little leeway is required, especially when the lengths grow longer. The chart on the screen shows FXE with time added to see the next Fibonacci time zone at 233. Even though the Euro ETF bounced in June to July, another leg lower is still possible, with the Fibonacci time zones forecasting a low in September 2010. 50 days were added to this chart to see the next Fibonacci time zone. After 233, The next line would be at day 377, which means the chart would need around 330 extra days for viewing. Fibonacci time zones are called zones for a reason. They are not hard reversal points, but rather potential reversal points to watch as prices approach this zone. Fibonacci time zones provide a cross between cycle analysis and Fibonacci analysis. Both have a wide following, and turning points can be forecast weeks and months in advance. However, these forecast points serve as alerts for potential trend reversals. As these reversal points approach, chartists should turn to other aspects of technical analysis to actually confirm the reversal. This could be a bullish or bearish pattern, bullish or bearish candlesticks, bullish or bearish indicators, or clues from the price chart itself.